Hey everybody, today I'm going to discuss Inherited IRA minimum distributions or RMD rules for inherited IRAs received from someone who passed away in or after 2020, the Secure Act. The rules for inherited IRAs before 2020 were different, but it's been a few years, so most of those inherited IRAs have already been dealt with. So today we're just going to focus on from 2020 on. The IRS requires owners of IRAs to withdraw part of their tax-deferred savings each year starting at either age 73 or age 75 if you were born in or after 1960. And of course, if you inherit an IRA, there are different RMD rules for different types of beneficiaries. Why? To make it easy. Kidding. It's the United States tax code. Unfortunately, it's not made to be easy. RMDs are designed to ensure that investments in IRAs don't grow tax-deferred forever and that Uncle Sam gets his pound of flesh. The rules for how IRA beneficiaries must take RMDs will also depend on when the account owner passes away. IRA owners generally must take their first RMD by April 1st of the year after they reach 73 or 75, again, if you were born in 1960 or after. This is called the required beginning date or RBD. So again, the date of death of the original IRA owner and the type of beneficiary is going to determine which distribution method to use. And you must take an RMD for the year of the IRA owner's death if the owner had an RMD obligation that wasn't satisfied. Okay, on to the types of beneficiaries. So essentially, we're going to have 4 different types of IRA beneficiaries. 1, we have spousal. Number 2, we have designated beneficiaries. Number 3, we have eligible designated beneficiaries. And finally, we have non-designated beneficiaries, which of course just seems crazy to me. I mean, designated beneficiaries, eligible designated beneficiaries, and non-designated beneficiaries. It just seems like they're trying to make it confusing. But I don't make the rules, so moving on. The RMD rules are different for each of these 4 different types of beneficiaries. First, a designated beneficiary, which is most common, is a person or a see-through trust, and they're going to be subject to the 10-year rule, which states they will be required to liquidate the account by the end of the 10th year following the year of the death of the original IRA owner. And the RMD is required in years 1 through 9 if the original owner had already begun to take RMDs. So, this means that if they die before their RMD age, the beneficiary can withdraw any amount at any time as long as they withdraw the entire amount in the 10th year following the death of the original owner. But if RMDs had already started, then the beneficiary will have to take an RMD based on their own life expectancy, but then in year 10, they're going to have to withdraw any remaining amounts. And unfortunately, as I've mentioned in other videos, this can cause a tax bomb for beneficiaries because they will be inheriting this money, what is most likely going to be their peak earning years, and will have to stack this ordinary income on top of their own ordinary income, which is going to cause them to pay higher taxes than before when they could have just used the stretch IRA to make relatively low RMDs over their life expectancy, instead of course having to take it all within 10 years. Moving on, eligible designated beneficiaries are exempt from the 10-year rule. Eligible designated beneficiaries are 1, either a spouse, 2, children under the age of 21, 3, individuals not more than 10 years younger than the IRA owner, or 4, disabled or chronically ill. And these beneficiaries can still take distributions over their own lifetime following the old rules prior to the Secure Act. However, once a minor child reaches the age of majority, or 21, they're going to become subject to the 10-year rule. So they basically go from an eligible designated beneficiary to a designated beneficiary. And next, surviving spouses have additional options. They can create an inherited IRA, and they might be able to use the original account holder's RMD age to begin taking RMDs based on their own life expectancy. Now, you might want to do this if you are under the age 59 and a half because you won't have to pay any penalty. And they can also roll the account over into their own IRA. No other beneficiary has that option. Next, a non-designated beneficiary is a non-person entity such as an estate or a charity or a trust that is not a see-through trust. A non-designated beneficiary would have up to 5 years to withdraw the balance of an IRA if the IRA owner was under the age at which RMDs are required. If the IRA owner was over the age 73 or 75 if born after 1960, the non-designated beneficiary may continue to take out RMDs over what would have been the IRA owner's original life expectancy. This allows the most funds to continue growth tax deferred for the longest amount of time. Roth IRAs are also obviously individual retirement accounts, so they are subject to the 10-year rule. However, no RMDs are required for Roth IRAs, but you will still have to totally liquidate the account by the end of the 10 years after the death of the original owner. But since there are no taxes payable on this money, you will want to leave it alone as long as possible and have it hopefully grow and receive it tax-free at the end of that time. Next, 5-year rule for Roth IRAs. Now, a Roth IRA has a 5-year waiting period after the first contribution before the earnings can be withdrawn tax-free. Now, assuming you've reached age 59 and a half. Reminder, you can always withdraw your own contribution from a Roth IRA anytime without penalty. But the 5-year period starts January 1st of the year the first contribution was made. This 5-year rule also comes into play when inheriting a Roth IRA. If the IRA owner dies before the Roth IRA has been open for 5 years, any earnings withdrawn before the 5-year rule is satisfied will be subject to income tax. Bottom line, if you're inheriting an IRA, be sure to check and double check to ensure that you're handling it correctly, because as you probably already know, it's easy to make mistakes with our convoluted tax code. And you need to pay attention to the type of beneficiary that you're going to be, as well as how and when you receive the assets, because it can have very large implications on your lifetime tax liabilities. Thanks for tuning in, and I'll see you in the next video. Once again, Tim Dorman here, founder of Eagle Ridge Wealth Advisors. And if you would like to see how we help our clients get the most out of their financial lives in retirement, please visit us at erwealth.com, and we hope to see you there.